Well, as everybody in this room, I'm also very happy to be part of this event in honor of Guillermo. I met Guillermo in 1979, 44 years ago. I was still an undergraduate student in Buenos Aires, and he was visiting SEMA. So I was a research assistant for a small period of time of Guillermo, and since then we have traveled many roads together, from friendship with Guillermo and Sara, from writing papers together, from doing policy, economic policy in Argentina. Lately, as Liliana mentioned yesterday, sharing our discussions in CLAF. All of this long history, and as everybody else, I'm part of this extended intellectual family of Guillermo, and very thankful for the contribution to my own development. Since Carmen described a lot of the IMF experience, I want to tell an anecdote which shows a different facet of Guillermo, and is his role in dealing with internal politics at the fund, which many of us actually experienced. So it was at the time in which I was writing these papers on domestic debt issues with Guillermo, and at some point, Maurice Goldstein, the deputy director of research, summoned me to his office and told me, well, you have to write an occasional paper with Mohan Kumar on domestic public debt of externally indebted countries. So we went and wrote the paper. Half of the paper was actually summarizing the work that we were doing with Guillermo. And following IMF procedures, once the paper was finished, was circulated for comments to other departments. When the comments came back, bad news. The Western Hemisphere department was horrified by the fact that we were using a phrase that said something like this, that governments may have the incentive to use inflation to reduce the debt burden. They could not conceive that the fund document could actually imply that governments would deliberately use inflation. So they would veto the publication of that paper. So we went and we debated of what to do with that. And Guillermo came up with the idea of, he said, well, let's do this. Let's eliminate the phrase resort to inflation, and let's exchange it for tolerate inflation. So inflation was there, and the question was whether central banks would tolerate. So, search and replace, and we sent the paper back to Western Hemisphere and came approved for publication, right? So it is actually a strange thing when you read it, that there is no mention of resorting to inflation, but it's actually tolerating. Finally, I want to thank Andy and Martin for this opportunity to actually reunite many friends, many former colleagues in this wonderful event. Well, let me go now to the subject of the panel. We have the presentation by Ṣebnem Kalemli-Özcan. She's Neil Moskovitz Endowed Professor at the University of Maryland, and will present a paper entitled Monetary Policy Cyclicality in Emerging Economies. That is a joint paper with Pierre and Gita Gopinath from the IMF. After that, we will hear from Linda Goldberg, the discussant, that is a financial research advisor at the New York Fed. So, Ṣebnem.
Thank you very much. Let me say a few words. I'm privileged and honored to attend this amazing celebration for Guillermo. I would like to thank Andy and Martin for inviting me. I wish I can start like many others in the room with something like when I was a student or when I was working with him in this institution or when he mentored me and all that. And I can't do that. And I'm not from Argentina, although once a very good Argentinian friend told me Turks are a bunch of Argentinian in the middle of Europe and it's not clear how they got there. So I didn't have any of those privileges, but I did learn a lot from his work, and I'm still learning a lot from his work, not just only by reading his work, but also a series of people he mentored who became mentors to me, Carmen, Carlos, Enrique, Maury, and so forth. This is even before I arrived at Maryland. So for those of you who may not know the time frame, Guillermo was the Distinguished University Professor and the Director of Center of International Economics at the University of Maryland from 1994 to 2006. I am the director of this center now, following Carmen, who followed Guillermo. This is an honor for me beyond words. Of course, being at Maryland constantly comes with this reminder that I should have been there when Calvo was there. Too bad I joined very late after the star left. So there is nothing I can do on that except working tirelessly on all these questions that he worked on all his life, as I do in this paper. Let me tell you that this is joint work with Pierre De Leo, who is there, my colleague at Maryland, and also with Gita Gopinath of the IMF. And Gita wanted me to say that she sends her regards, regrets not being there due to G20 meetings in India. And you can see the authors on this paper spans two of Calvo's institutions, IMF and University of Maryland. And I also want to say that we started working on this paper when Pierre just arrived at Maryland, and I was away working at the IMF as the senior policy advisor to Gita, who was the chief economist then. And as we heard from Jacob, this was a similar situation when Jacob and Guillermo started working on many papers together at the fund at those same roles. Now, let me also say that the views are only our views, do not represent the views of the IMF, Executive Board, or IMF management. All right, so let me start by telling you that we would like to understand emerging market monetary policy making in this paper in a positive sense. We are not going to have anything to say about optimal policy or any normative statements. We would like to know what they do, why they do it, okay? And the starting observation is going to be one you're all familiar with. Guillermo said this yesterday, the external factors, the importance of external factors. And here we start with the statement that emerging economies largely exposed to global financial conditions. And changes in global financial conditions pose trade-off to emerging market central bankers. We have many emerging market central bankers here. Clearly, nobody is going to doubt this. Now, let me start with an example, current example, as we are living through current US monetary tightening. What happens when US tightens? That means tighter global financial conditions, deterioration of economic activity, not just in the US, globally. We also know emerging markets suffers more from this. We can follow this through, but you are going to see that Mexico is going to suffer more than Canada when US goes through this tightening. What can central banks in emerging markets do? They have two options. They can increase the policy rate to avoid large fluctuations in capital flows and the exchange rate. Of course, this goes back to yet another classic paper by Calvo and Carmen on fear of floating. Most of the time, we just say fear of floating, and we don't even cite the paper, going back to what Fernando was saying yesterday. So that's number one. Number two option is they can lower their policy rate to elevate the deterioration in the economic activity locally. Now, no matter what they do, global financial cycle is going to challenge domestic monetary effectiveness, and this is something Murray also worked on. And we are going to come back, actually, basically to that conclusion. Okay, so we are going to do three things. We are going to document two facts, and then we are going to propose a model for those facts. Let me go very slowly, because some of these things can be a little surprising, but at the end, I hope I'm going to communicate the message coming back full circle to fear of floating issue. All right, first we are going to document central banks cut policy rate when GDP growth is low in emerging markets. We are going to do this in 4 building blocks. First, we will show this unconditionally. Second, around periods of global distress, or what we call risk of shocks. What are those be? Global financial crisis, taper tantrum, COVID episode. Third, we are going to do Taylor rule estimation. Fourth, we are going to do this in response to identify exogenous US monetary policy tightenings. Okay, so each of these things is going to show you that central banks cut policy rates when GDP growth is low in emerging markets. Okay? Second, we are going to document a disconnect between policy rate, monetary policy rate, and the short-term market rates in emerging markets. The rates that are relevant on all the things, for all the things we care about, consumption, saving, investment, and so forth. We are going to show you that market rates are going to be high, increasing, when GDP growth is low, and also in response to identified US monetary policy tightening for emerging markets. There is no such thing in advanced economies. Advanced economies, you take market rate, policy rate, same thing. Okay, short term. Finally, we are going to propose a model for this phenomena. We are going to call it short rate disconnect. Okay? And the model's key ingredient is going to be about policy pass-through to market rates, so monetary policy pass-through to short-term market rates being incomplete. So it's an impaired monetary policy transmission. Why it is incomplete? Because emerging markets fund themselves globally, in the global financial markets. That's going to be important. So here we are going to put a lot of emphasis on financial intermediaries, domestic financial intermediaries, not global. Those domestic financial intermediaries funding conditions, they fund themselves in the global capital markets, domestic banks, are going to be the key thing determining market rates for the citizens of Turkey, of Mexico, of Argentina, of Chile. All right, let me go one by one. Before, let me, of course, tell you that we are obviously related to a very large literature, transmission of global financial cycle to emerging market business cycles, this relation of this to the monetary policy independence, of course, monetary policy making in emerging markets, fear of floating, going back to Carmen's and Guillermo's work, business cycles in emerging markets, looking at the real rates, started with the work of Andy's and, Mark and Gita, Martin, and many others in the room. I mean, everybody in this room work on these things. So I'm obviously putting papers there, but I'm sure I'm also forgetting papers. Now, let me start with monetary policy making in emerging markets. Again, please do not take any of my statements as this is what they should be doing, this is the optimal thing or not optimal thing. I'm just telling you what is in the data. We are going to start with empirical evidence of policy rates around periods of global distress. So take these as risk of shocks, global financial crisis, taper tantrum, COVID. Then we are going to do the Taylor estimation or less estimation of Taylor type rules. We are going to show you the dynamic correlation of policy rates and the market rates with GDP growth, and then what goes on with, again, dynamically policy and market rates when US monetary is tighter. Here, obviously, it has to be an exogenous tightening, so we go with the state of the art in the domestic macro literature here. We are going to use Gertler-Karadi, high-frequency identification to get at the high-frequency surprises in the US interest rate. Let me tell you something very important here. I don't know if I have the pointer, but okay. So we are going to focus on the flexible exchange rate regime. But let me be very clear. This doesn't mean we are going to drop, people, countries with fear of floating, manage flows and all that, what just Carmen said. So we are going to use this amazing classification done by Carmen, Ethan, and Ken, Ildesk, Reinhard, Rogoff. That is a time-varying classification and very granular if you work with this data. So that classification is going to allow us to drop the episode of fixed exchange rate. When I say fixed exchange rate, hard pegs. Okay, if you are familiar with their classification, it is like, from 1 to 6, so we are going to drop that 1. So we are going to have the crawling bang, the managed floaters here. That's going to be important for us to also drop the fixed guys, because of course with the fixed guys, you don't be able to, the monetary policy is going to mimic the US policy, there's no concept of UIP and all that, okay? But this is going to be important. So we are going to have all the other guys, de facto, de jure calls them flexible, but they also manage the exchange rate. All right. Let me start by showing you these episodes. So this is COVID. So with hindsight, of course, you are going to say, well, of course, everybody cut the rates. This is a different shock. Yeah, we know this now. We didn't know it by March 2020 and April 2020. And if you look at the commentary during March and April, it was like, the end of the world is coming. Sudden stops is going to happen. There's a series of, all these things and blah, blah, blah. But of course, it didn't happen. Why? Guillermo said why it didn't happen yesterday. Amazing stimulus put by US Federal Reserve, huge dollar liquidity in the system. And if you go back and look at the data, I mean, there wasn't even, there was a little bit of a reversal. They dumped the government bonds, But in terms of the private capital flows, nothing really happened. In emerging markets, also advanced economies, and as you can see, everybody cut rates. The median country, mean country, everybody. So you say, okay, maybe, even I would agree it was a risk of shock in March and April. You might say, well, there was a lot going on with COVID. Let's look at the global financial crisis. Global financial crisis, again, everybody cut rates. The median emerging market, mean emerging market, same with advanced economies. Obviously, you have Iceland there, the famous case, but let's focus on the emerging markets. On the left, you see two famous hikers there, Russia and Hungary. But without, apart from them, basically, that wasn't a typical behavior. Median and average country was cutting rates. Let's look at taper tantrum, maybe which is more relevant because it was specifically on emerging markets. As you remember, Ben Bernanke's speech, May 2013, led these capital outflow episodes out of emerging markets. Obviously, nothing going on in advanced economies. Again, everybody cut the rates, except Brazil and Indonesia, famous to be on the record that they are going to hike to defend the currency. If you go and look at the statements at the IMF, Indonesia, and also Brazil, but Indonesia very vocal on, we are going to increase the rate to defend the currency, stem the depreciation and capital outflows. I would like to make this point because we talked a lot about this yesterday's panel, and Andres was very vocal, why currently, Peru, Chile, Brazil, doing these things before the US, hiking and all that. I think this is very different, what is happening currently and what is here. These guys were clear they are doing it for depreciation and capital flow purposes. If you look at the current increase of Peru, Chile, and Brazil, go and read their statements. There are central bankers here in the room from those countries. They say nothing about currency depreciation and capital outflows. They say they have an inflation targeting frameworks, economy is overheating, and then they are increasing rates. Okay? So I would like to make sure we communicate that difference. All right, so the next building block. So these are the events. Next building block is the estimation of central bank reaction function. You can see the process we are estimating at the top with interest rate smoothing, inflation and output gap. The first two columns, emerging economies. Last two columns, advanced economies. You talked a lot about this yesterday during John Taylor's address. So here, of course, what I want you to look at is the coefficients similarity on inflation and output gap of growth, depending on you use GDP growth. Column 1 and column 3, or output gap, column 2 and 4, you get very, very similar estimates in emerging economies and advanced economies. What do they mean? Basically, a Taylor rule characterizes policy rates fairly well, using GDP growth or output gap as a measure of economic activity. So, of course, this is big emerging markets. You have to be very careful. We, do tons of robustness here. I mean, if you're interested, I can tell you all, but they're all in the paper. We took out high inflation episode. We took out crisis. So we do a lot, and we still end up with the same conclusion. These estimates are being similar across emerging and advanced economies, of course, consistent with I just showed you also with the event episodes. In terms of the Taylor coefficients, what those estimates imply with this equation, a coefficient on the output gap of 0.5 and on inflation 2, but that's 1 plus the Taylor coefficient, okay? So this basically says if you measure the monetary policy stance with policy rate, it is countercyclical. Okay. So then what is going on with the borrowing cost? If we have this, then why the borrowing cost is increasing, which we also know what is going on in emerging markets. So let me get at the short-term borrowing lending cost in emerging markets, which is, of course, what is relevant for the economic decisions. All right. Let me start from this measure of the policy rate in the data we use. Policy rate measures the stance of monetary policy. It is the target interest rate set by central banks in their effort to influence short-term interest rate as part of their monetary policy strategy. Now we are going to show you that this is completely fine for advanced economies. In emerging markets, short-term market rates measure the stance of monetary policy imperfectly. Let me read that again. In emerging markets, short-term market rates measure the stance of monetary policy imperfectly. This is short rates. I'm not talking about term premier here and all that, okay? We are talking about short rates. What are the rates? Treasury rates, rates on government bonds, money market rates, rates on loans among banks. We also do loans rates, and of course, once you have the money market rates, that's going to be very similar to the loan rates, the loans to firms and households and all that, okay? So we are going to argue that these market and policy rate are going to differ by this premium that is attached to the underlying lending relationship. So let me show you the behavior of these 3-month rates. We do 6 months, 12 months, basically everything less than 12 months, which in US is taken to be identical with the policy rate, right? So I'm going to show you now the 3-month. Okay, so this is a dynamic correlation. It is a local projection. Interest rates on the left-hand side, here done with the GDP growth. On the top, I have emerging economies. On the bottom, advanced economies. Focus on the left-hand side. So the blue is the policy rate, red is the market rate. Okay? So you see when economy is growing, policy rate goes up, but the market rate goes down for emerging markets. Advanced economies, they behave exactly the same. So policy rate goes up, blue, market rate goes up, red. Which means, if you look at the second column here, so right bottom, there is no disconnect in advanced economies, it's 0. What is the disconnect? Market rate minus the policy rate. In emerging market, it is negative. Why? Because market rate goes down, policy rate goes up in good times. So that's a negative disconnect. And we use, we do this with several things, money market rates. We look at countries using the interest rate-based monetary policy and all that. So every robustness in the paper, the results are going to stay. Okay. Now the fourth piece. Remember, I'm going to show you these things unconditionally, dynamic correlations, events, and finally, as a response to identify US monetary policy shocks. So here, 1 percentage point exogenous increase in the Fed funds rate identified through Gartner-Karadi high-frequency identification. What happens? All this is data. This is completely model-free. All in data. First, all the typical outcome in the bottom that are shown by many others, not just us. US tightens. The economic activity, the real GDP growth contracts in emerging markets. Inflation goes up first because of currency depreciation, then down because there's a recession in the economy. Capital flows out. Okay? So this is, you've seen these before. On the top, the borrowing lending market rates, treasury rate and money market rate, they both go up. Okay? You might also have seen this before. What is important here and what is new in our paper, this is all happening with loosening of policy. That you may not have seen before. The first little figure there, they loosen the policy, but they cannot stem all these bad things that we write down many, many models to explain. The contraction in the economic activity and higher borrowing costs. Okay? And the capital flowing out. Yeah. Yeah, so this is all data, so I'm going to come to the model now. I mean, of course, but this is why it's like impaired transmission, right? It's not full, so it's less than full pass-through. Think it like that. Okay, so let me summarize the takeaways. Market and policy rate display opposite cyclicality in emerging markets, okay? There is no such thing in advanced economies. They are identical cyclicality in advanced economies. Market and policy rate display opposite response to US tightenings, identify exogenous US tightenings, which is very relevant for all of us given the current juncture in emerging markets. Policy rates decline after US monetary policy tightening, but market rate increase after US monetary policy tightenings, okay? Which I expect to see now going forward with the tightening in the US. Now, why do we care about this? Why do we want to distinguish between market and policy rate? This is going to matter for a lot of the things we care about. First and foremost, of course, to interpret the cyclical stance of monetary policy, we need to know. Second, interpretation of the equilibrium determinant of the rates, we need to know. And third, and this is in my view, super important, measuring UIP deviations. This is a key wedge in all the recent optimal policy models of emerging markets, and we have to know how to measure the UIP deviations. Okay. Now, this, maybe like at first, it is the surprising finding. Can we really write down a model to justify this? Like, how can we put in a simple model that we will get this short rate disconnect, this less than full pass-through of monetary policy rate to market rates relevant for economic agents? It's actually not that difficult. In fact, it is going to come out very naturally from collateral constraint models, okay? On a closed economy setting, Gartner-Karadi did this. There is a constraint on home banks' capital market access. So any model is going to give you that. In the open economy context, done by Enrique originally as a country collateral constraint, Gabay Maggiore put the constraint on global banks. Gita's work with colleagues at the IMF on integrated policy framework, Basu et al. Paper, they also, in an open economy context, have the constraint on home banks. So once you have this constraint on the financial intermediary, you can actually get this very naturally from these models. So there isn't that big a puzzle behind it. These models are all going to give you this short rate disconnect. We want to do it we want to see if we can do it even simpler than that. Okay, can we just write down a bare bones simple model that will give us the short rate disconnect? Okay, just super simple. A model of international funding costs where home banks have to fund themselves through foreigners and domestic households deposits, so Mexican banks funding themselves both through Mexican deposits but also the US household deposits. And in that world, that funding cost, that international funding cost, fluctuating with risk on and off shocks. So can this type of a model give us this finding, what we find in data? And the answer is going to be yes. And the key is through tighter global financial conditions, means higher marginal funding costs for the home banks. So the Turkish banks, Mexican banks. Let me walk you through, in the remaining time, through that model. It is going to be super simple. So two countries, small open economy. So the small open economy is Mexico. The large country is the US. Small guy is the net borrower. Home households consume home and foreign goods, very standard. Supply labor to firms. They are going to be borrowing at short-term market rate, relevant domestically in the country. That's we call I-Treasury. That's the market rate that behaves differently than the pulse rate I showed in the data. Home firms, obviously, we are going to rely on another classic, Calvo 83, sticker prices, producer currency pricing, all this standard. For the monetary policy, we are going to have central bank target CPI inflation and GDP, a la Taylor rule. So the key, all this is standard. The key friction here is going to be asset markets are going to be incomplete and segmented. What do I mean by that? So there are going to be certain agents trading certain bonds, and this is going to be the home banks intermediating bonds and deposits, and your intermediation is going to determine that market equilibrium rate, and that's, of course, going to give us the disconnect policy rate set by central bank. And the other key is going to be the fact that home banks, Mexican banks, are funding themselves through foreign savings, foreign funding, that omega bit, and that share is going to be important, which I'm going to define all these things now in a minute in this figure. Okay, the structure is extremely simple. So there is the Mexican central bank, there is the Federal Reserve. So home sets I policy, that's going to be the rate. Households, lending to banks. And here, the other side, the foreign central bank, Federal Reserve, is setting the international risk-free rate I star. Okay? So everything on the US side standard, there's a global bank raising the funding at I star, think this JP Morgan. Profits redeemed, US household providing labor to US firms, wages and profits go back. There's trade, goods trade between the countries. Again, everything standard on the Mexican side, home households, home first. What is new is, and that's exactly why we want to keep the model simple and bare bones, is this, and that's exactly what Carmen was talking about. So, we didn't want to be like IMF, and we want to take seriously bank credit and domestic banks. So this is what we are doing, okay? What Carmen was talking about. So domestic banks are going to have these assets. These are Mexican banks, right? So they are this is the household bonds, treasury, government bonds. So they are going to be borrowing at the treasury, this IT rate. So they have to be funded. Balance sheet, importance of balance sheet, Carmen just talked about that. They are going to be funded by domestic deposits as standard. The new thing is, so that's DH, that's the Mexican savings. The other one is the D star, that's the funding from the US. From the US households, okay? And that, you see the key, as we show with this broken arrow there. So that international borrowing rate, I star hat for Mexican banks, is going to be different than the international safe rate, Fed funds rate, I star. That is the key thing, okay? And we are just going to throw that at you. There are several ways of modeling that. Right now it's exogenous, okay? But we want to see, just with this very simple structure, how far we can go, not only in terms of proof of concept, getting the short rate disconnect, but also in terms of impulse responses. The dynamics of this model is, of course, going to be much simpler than the dynamics of the collateral constraint models. So that's the model. Okay, so as I said, this international funding from global banks, that's going to be at the international borrowing rate different than the safe rate, which is set by the US Federal Reserve. And as I said, there are several ways of doing this. We are going to do this exogenously. You can endogenize this, as in Helen Ray's work. Pierre Olivier have his exogenous. Javier here have a hybrid. So we are just not taking a stand on this yet. We all want to see if we can have this exogenous difference, and our aim here is this meant to capture this unmodeled changes in the risk perceptions of the global finance, global investors. And that's going to be correlated with US monetary policy stance, as shown by Helen and Sylvia, and also in my 2019 Jackson Hole paper. All right. These are risk-neutral banks, competitive banks, and they maximize the profits. That gives you the market rate, that IT. At the steady state, obviously, everything is going to be equal, so international borrowing rates are equal. We are going to log linearize the model around the deterministic steady state, and the disconnect is going to appear. You see disconnect, treasury rate minus the policy rate, and that's going to be a function of omega times these difference in the international borrowing rate. I star hat, what Mexican banks borrow at, I star what JP Morgan borrows at. And that's multiplied by omega. That omega, that's a time varying variable in the model, of course, but we log linearize around the steady state. So we use, for calibration, the steady state value. Okay, the steady state value, D star over B. D star is the saving of the US household, B is the total debt. So that's the share of foreign funding. So share of foreign liabilities on Mexican banks' balance sheet. Okay, and that we know that number. That's 0.3. That comes from the data. Okay. Now, this mechanism is very straightforward in this bare bones model. Banks pass international borrowing rate to the market rate because they are the key intermediary here. Again, this goes with this saying that all of us from emerging markets and from our talks with emerging market central banks or working at those central banks know this, right? Emerging markets, domestic banks are the market makers. Okay? So they are the marginal investors here, they are the market makers, so we are sticking to that powerful observation. Once you have, of course, banks passing these rates to the market rates, then, of course, that means UIP is going to hold in the policy rate, but it's not going to hold in the market rate. Okay? So UIP deviation is going to show up exactly as this disconnect, so there's going to be a UIP deviation in the market rate. Okay, so these are the impulse responses from the foreign monetary policy tightening, now out of the model. If you remember the blue figure, I showed you exactly similar figures with the data. So what is going on here? So we are going to have 1 percentage point shock to the innovation in the Taylor rule. That's the I star with the dotted line. So I star hat is going to be higher than that. So that's what we feed in the model. So that top right figure. And everything else then comes out from the model, and these things, again, you've seen coming out from other models too. We are not saying this is the D model, but this is a very simple way of generating these. GDP contracts with US tightening, inflation goes up with depreciation but then goes down. Net exports, the typical counter-cyclical net exports of emerging markets, we have that. Market rates, borrowing costs go up, and this is all happening when the policy rate is going down, okay? The policy is losing. Yeah. Okay, so let me take away, go through the takeaways and then come back to full circle to Carmen's and Guillermo's work. So model reproduces responses to US monetary policy tightening fairly close to the data. Given the simplicity of the model, we think this is good, right? I mean, obviously we can do much better, but as I said, we just wrote this down as a proof of concept. Now, short-run declining GDP, where is that coming from? In spite of the looser monetary policy, that comes from, of course, lower absorption, lower foreign demand, lower domestic demand, right? You have high borrowing costs. Now, CPI initially increases, as I said, because of the currency depreciation, then declines, again, due to aggregate demand effects. There's a trade-off, of course, for the central bank. Calibrated Taylor rule is going to give you lowering the policy rate, as in the data. Market rates increase, as in the data. And this foreign funding at higher cost is going to be instrumental for that. Because you are getting foreign funding at a higher cost, you immediately pass that through to the market rates. Now, the caveat here is we don't model this difference, I star hat minus I star, and we are now working on this model, going to be a home bank constraint model, similar to Gita's paper with IMF colleagues on integrated policy framework, but of course that's a 3-period model. We want to do this dynamically, okay? Right. Conclusion, and then coming back to reflections. So the paper shed light on monetary policy conduct in emerging economies. Monetary policy stance, as implied by policy rate, is counter-cyclical. So this means there is going to be a disconnect between policy and market rates, which means limited monetary policy effectiveness. Not zero, but limited. It's impaired monetary policy transmission, and the calibrated model can rationalize this disconnect by emphasizing, of course, the role of exposure to varying global financial conditions. So what does it all mean? Does it mean fear of floating stop? No. I fully agree with what Carmen said. So let's go back to that paper and let's think about the primitive. All these models are going to be, in my view, reduced forms for this very important primitive, which is lack of credibility. Credibility of policy is extremely important for emerging market central bankers. If you go back to fear of floating paper, you see they say we provide a model for fear of floating when there is lack of credibility, right? Then they say, the continuation of that sentence is, let me quote, it is worth pointing out that lack of credibility in this setting is not manifested in first moments. Lack of credibility is associated with the higher variance of the risk premium shocks. This is directly from their paper. This is what we are trying to do, right? So our model is a very reduced form way of doing it. There are other ways of doing it. So here, UIP wedge captures that risk premium shock. How? Through home bank intermediation, banks are passing through this international risk rate to home rates. Okay? But the underlying primitive here, what is tried to be captured with that difference, that interest rate difference, is really a lack of credibility. Okay? So if you wish, see this another broader form of fear of float. Right? Maybe they are doing the right thing with the policy, or maybe they are trying to not to be fear of floating with the policy rate, but they are still are, in a way. Remember, we have all sorts of other tools to manage the exchange rate. We have managed flows in this sample with reserve management, capital flow management, and all that. And that type of, in a sense, because they lack credibility, it shows up in the international borrowing cost and in the UIP wedge. And one piece of evidence I can offer you on this, if you just plot the UIP wedge, so the market rate difference minus the expected change in the exchange rate, using expectations, you would see that black line for emerging markets. What do you see in that black line? A lot of fluctuations, but you see it is always positive, it is always above zero. Zero is when UIP holds, so it never holds in emerging markets, okay? So it is positive means there's always excess returns to emerging market currencies. That's what you see in the black. This is from my paper with Liliana Varela, another Argentinian. Now, the key here is the blue, the strong correlation with the blue. What is this? Blue is a measure of policy credibility. From the work by Nick Bloom, Steve Davis, and Scott Baker, as you know, this work is all about second moment and risk premium shocks, exactly what Guillermo and Carmen was talking about. So this is just their measure, not our measure. We just extend it to emerging markets. And if you extend it to emerging markets, you plot them together, you see lack of policy credibility and the UIP wedge and the higher cost of capital goes together. So what I want to say at the end, another way of seeing lack of credibility being the underlying primitive, feeding through fear of floating, and going back to the discussion yesterday, Ricardo Andres. So if the emerging markets want to reduce their international cost of borrowing, they have to listen Calvo and they have to fix their credibility issues. Thank you.
So it's great to be here. I want to thank you also. The thought leadership, your tremendous contributions, everyone's spoken to that. I also want to say something about how you've contributed, not just what you've contributed, which is when Carmen went through this incredible series of just like, a fraction of your contributions, your published contributions. If you looked, they weren't all in top journals. So you were doing this work, making your points, influencing so many people, and the kind of output was that influence. You weren't bound by having to put this only in the top places, and I really admire that, and that, that's a way to have lasting impact. So I appreciate that. On my own work, you've influenced, starting from day one, on exchange rate crises, on currency consequences, on international capital flows, even a more recent direction that many of us have taken, that the institutions matter and granularity mattered. And also even from, I'm speaking on my own behalf, not on behalf of the Fed, even thinking about dollar liquidity facilities and how those work. So again, thank you even, in terms of getting to the paper itself, do I need to use both of these? Or if I'm standing here, I'm fine, right? As Ṣebnem really clearly discussed, the paper has a number of pieces. The key part is identifying this empirical wedge between the local policy rate and local short-term funding rate. And that's a cautionary flag for researchers everywhere because they're often used interchangeably. And then the next important finding is that the dynamics of the wedge are tied to local GDP growth for emerging markets, where market rates are pro-cyclical and policy rates are counter-cyclical. So that's a really interesting finding. And then the wedge for emerging markets is explained using a stylized small open economy model. The key mechanisms I want to emphasize are working through aggregate demand effects and the funding costs that are associated with the rest of the world, which in this case is the US monetary policy. And the sequence is that think of emerging markets as having a marginal source of funding that's provided by foreign banks, global banks. The country's short-term interest rates are a weighted average of local and foreign-sourced funding costs. So when U.S. rates rise, the demand and GDP is playing demand is playing a big role here. When U.S. rates rise, demand for emerging market products falls, local GDP contracts, and then the emerging market central bank reduces policy rates. So you get that gap opening up. And so weighted average cost of funds rises as local GDP falls. So that's kind of the mechanism, the story of the paper. So in terms of my comments, I'm going to have them in four parts. One is on global liquidity flows. I'll give a little schematic representation. Global liquidity, by the way, is the cross-border financing that's intermediated by global banks, which is here. But also by non-bank financial institutions. And I also want to point out across EMs, it could be in dollars, euros, or local currency. So that is something that changes over time, should have an effect on some of these estimates. I'll also point out that the type of intermediaries matter for the funding rate responses to policy rates domestically and internationally. That there are rate wedges that arise both for advanced economies and emerging markets. And the lessons from the finance literature, a lot of the more recent stuff with a granular focus, also talks about the role of compositional changes in the global, in who's providing liquidity. And in this context, you should see compositional changes when the composition of global liquidity providers are changing, when the currencies are changing, and also when the maturities are changing. All of those should be impactful for the discussion of beta. I'll give some comments on the empirics about expanding the local projection estimates to explore some of this evolving transmission that I would expect to see across time and across countries. And finally, a couple of comments on the model. So for the my IMF Mundell-Fleming lecture in November, I put together a stylized depiction of global liquidity flows, just showing it here, that when you think about global liquidity provision, there are global banks. Some of their flows directly go to banks within some local economy, so that's the interbank lending to domestic banks. Global banks also have intra-bank lending, where that goes to their affiliates that are hosted in foreign markets. Global banks can lend directly to non-bank borrowers. And increasingly, we have non-bank financial intermediaries that lend to domestic banks and also directly lend to non-bank borrowers. So there have been a series of phases of global liquidity provision since the 1980s, where basically, you start out with bank-based cross-border lending. You go to a global bank expansion after some of these crises that were talked about earlier, that after banking crises, sometimes global banks were allowed in for the first time to lend domestically, internationally, and bring in their expertise and sources of funding. And now we get an expansion of international debt securities and non-bank financial institutions. So there's a whole thing also with risk migration across these players. And what you see if you think about the evolving composition of liquidity for advanced economies and emerging markets, this is from a borrower perspective. These are totals for advanced economies on the top and for emerging markets on the bottom. The side, I guess from your side, the left side, is banks getting funding internationally, and the right are non-bank borrowers getting funding internationally. So what you see is that, staring at this, that banks in emerging markets and advanced economies continue to rely on short-term funding, interbank flows, the main channel that's discussed here in the paper. However, the financing of non-banks is now larger. So it's not just banks intermediating capital, okay? So the financing, direct financing of non-banks is larger. It's dominated by international debt securities, and it includes direct lending by global banks. So why I'm mentioning that is that, just to put into perspective, the mechanism, I think, within the paper is this bolded part out of kind of an evolving international financial system. Now, I'm just taking the model literally here, and so you could argue that that literal depiction isn't the right depiction. But I wonder if procyclicality, as discussed in the paper, these dynamics, the model, would change with the enhanced differing roles now of global banks, with hosted branches and subsidiaries, because internal capital markets and funding costs are different in that context, and the migration of riskier borrowers towards non-bank financial institutions and international debt securities. So I'd kind of like to see some of that discussion. Now, Ṣebnem showed the graphics on the local projection empirics. And the results on cyclicality, these are the two key equations that are estimated. And when you talk about cyclicality, procyclicality, countercyclicality, it's that beta of these estimating equations. And Ṣebnem already showed how this is just for emerging markets. And on the top, we see money market rate results, and then there's other rates that are or on the bottom are the money market rates. And it clearly does show that local policy rates dynamically depart from local money market rates for emerging markets. And the beta on the money rate is interpreted as reflecting some global liquidity share and rate contribution. So here, one suggestion for the authors is, I think it'd be incredibly interesting to test conjectures within that their results about the cyclicality of these rates to better inform how that beta is likely, I really think is likely, changing across times and across countries. And I think the mechanisms should be true for both advanced economies and emerging markets if you kind of have a richer set of specifications on this estimation. So what about the country and currency of marginal funding, euros and dollars? Emerging markets have a mix of those. What about the duration of funding? Longer means lower correlation of policy with policy rates. What about policy reaction functions? So when you have a role of inflation targeting, that should reduce some of these beta effects that are here. Regulatory policies and around risky borrowers, consistent with your direction of going, talking about frictions. And just this reduced interbank funding and increased competition in providing financing with different types of entry. And there's evidence that this type of heterogeneity really does matter. And what is it that's driving actually the important distinction between AEs and EMs? I think you'd be able to see that with this kind of richer set of empirical specifications. On the model, I think the model beautifully illustrates the pro-cyclicality, counter-cyclicality contrast. However, I'd like to see the model kick the tires a bit and relax some of the key assumptions that deliver the wedge. And so the kind of assumptions that kind of push you towards validating the wedge are around the lack of imported inputs in production. So if you added those, I think you would increase the sensitivity of domestic inflation to kind of foreign policy. Weaken price rigidities. Again, you'll get more of an inflation impact from the foreign policy. Reduce the importance in the model of producer currency pricing. Introduce local or vehicle currency pricing. All of these matter because in the model, the domestic policy rate response is driven mainly by GDP. So if you have assumptions that kind of are putting a higher weight on the inflation responding, then I think you're going to lower the wedge, basically. Differentiate countries by monetary policy rule. What happens if you kind of break out those periods of time and you contrast? Relax risk neutrality. Everything in here is about short-term financing. What about if you kind of go more duration? And the last point I think I'm incorrect on, that you already have an endogenous foreign share financing. So I like the model. I like the direction it's going, but I think you can enrich it this way and then tie that into the empirical side for the local projection results. So this is a highly relevant paper. It's perfect for this conference. It ties really well into so many of the themes of Guillermo and so many here. By the way, can I just interject a personal note? The first time I met Guillermo, I don't know if you'll remember this, it was in my first conference in Latin America, and I raised my hand from the audience and I addressed him with a question. And his response, before responding to the question, was, "That was the worst pronunciation of my name I've ever heard." And I'm so thrilled to see so many people here are pronouncing his name so many different ways. And then he went on to answer my question. So, Guillermo, I'm doing my best. The paper documents new and interesting empirical observations. There's an illustrative model. We've talked about the wedge. The cautionary flag holds regardless. But I think, it would be great to have deeper exploration with the empirics and with the model coming together, and I'm looking forward to seeing more of this. Thank you.
Yeah, so this is a very, very nice paper, and I think the discussion was also great. I'd like to maybe draw something from the conversations we had with Guillermo a long time ago to do in the paper we wrote about Chile, where we were pondering how come Chile had this issue with bringing inflation down, and how we fit that into a common framework of inflation targeting or inflation Taylor rule. And some of the discussion that we had to do about the provision of liquidity, and maybe connect with more of his recent work, in the sense that when you look at emerging markets trying to manage things with interest rates, the liquidity they need to provide is like dollar liquidity or is tradables liquidity, but these interest rate instruments don't really get at that. Maybe some mix because it's kind of the aggregate CPI, so there are some tradables, some non-tradables. But certainly the mechanism, the way it works is different from, in that aspect, from when the Federal Reserve reduces its rate, it's providing dollar liquidity to a market that needs dollar liquidity. And then the second comment is about Europe. So in terms of this issue of this disconnect and interest rates or policy rates moving down, but market rates going up, I think one place where we may have seen it happening is in the European debt crisis with respect to the sovereign debt, where policy rates are going down, but the spreads are going up, and they may have had a lot to do also with the banking system positions on the debt.
Let me take one more, and then maybe you can. Gian Maria.
Great paper, great discussion, and fantastic conference. Just a quick question to Ṣebnem. Can you split your sample of EMs into sort of those more integrated in international financial markets, those that receive the largest capital flows, and a second tier ones? There was, Carmen mentioned the Egypt issue. Egypt may be too close to a peg to make it in your sample, but there is clearly a difference in the reaction between the main EMs that get most of the flows and the Pakistans, the Sri Lankas, the other countries which have, face tighter financial conditions and have less access to borrowing in domestic currency. Thank you.
One more, and then you can, Luis.
Super interesting paper. I have a couple of questions. One of them is related to something that Linda was mentioning. There is a lot of heterogeneity across countries. And the other one is related to what Enrique was saying. And it's the fact that I think many emerging market economies understand that the provision of liquidity, dollar liquidity and peso liquidity under certain circumstances is different. So that's the reason why many emerging market economies accumulate international reserves. It's precisely when they're hit by financial shocks, they're able to introduce that liquidity, dollar liquidity in the market, precisely because of the wedge that you showed, that I would call the spread on shore. So you saw, and in fact, in 2008, 2009, you saw not only that emerging market economies required that international liquidity, but also very advanced economies went for a swap line with the Fed. So I think that there's a lot of also other things that you can discuss in the paper. It would be very interesting to also add other type of shocks, because emerging market economies not only face financial shocks, and in that case you might require that international liquidity, but also real shocks. And in those cases, maybe the flexibility that our arrangement like inflation targeting can provide can be very useful.
Okay. All right. Okay, thank you so much, Linda. Great set of comments. Yes, I mean, we have done a lot of robustness, but we will definitely do all the things you said. Let me just do a clarifying issue here, since this came up. So obviously, there's a currency dimension here. That's why UIP is critical. So they do get the dollars, and they convert it to something, peso, lira, right? I mean, this is not the case for US, for Canada, for Europeans. So you get some foreign currency like euro dollar, but then you convert it. So that is important. We have that. That's why it shows up in the UIP badge. But going back to Enrique's comment, well, this can maybe show up in advanced economies. Linda has the same thing. True, it did happen during the European debt crisis. I mean, if you look at the literature that models this, Monica Piazzasti, Martin Schneider has a paper, it has to be, one of those specific frictions, like a very specific event where the default risk increase, or a very specific friction in the intermediation, right? Like the rates spike up, like the treasury rate. So it can happen, but very, very unique and one-off things for advanced economies, right? So here we are saying this is life for emerging markets. It is not just about one big shock like COVID or one sudden stop, or that's why there's like 4 sets of results here, right? Like normal times, crisis times, big shock. So it always happens. So that's, I think, very important. Jean-Maria, yes. I mean, right now the splitting is done thanks to Carmen's great work, right? So the Iletsky-Reinhard-Rogov classification already gives you that, because once we drop those countries, we are getting rid of Pakistan, Sri Lanka's, emerging market, those countries pretty much. They are, I mean, 2/3 of our observations are not going to be those countries, and after 2000s. So that's kind of done endogenously, but we can do better splits. Like look at some classification of financial integration and see what is going on. Our omega is, of course, another endogenous way of getting at that. That's, you are more integrated, your share of foreign funding is going to be higher. Right now, we calibrate them to average emerging market, 0.3. For more integrated guys, it can be higher. So we can do more on that, that's for sure. And just the final point on is, yes, heterogeneity is, of course, very, very important. But let me tell you, and that you can use other tools, right? Say you don't use the monetary policy, you do reserves, FX interventions. In fact, the integrated policy framework is all about that. That's an optimal policy framework, and it tells you use these other tools, so you don't touch monetary policy. That's used for domestic stabilization. But I guess what we want to highlight, that's why I finished with that quote from Carmen and Guillermo. If you are still lacking credibility, this is going to show up somewhere. That's why it shows up UIP wage. So let me put it this very simply. You don't gain credibility with accumulating reserves. You gain credibility with your policy actions. That's, I think, the final word I want to say. And just one name, Turkey. I don't even have to go to Argentina. So the country was pretty much targeting their inflation very well for several years, and then they lost credibility, everything off. So you guys are doing great. Thank you.